Let's talk about the yield curve. You've read about it, you've heard about it, you've seen it in the news, but what is it? When we say yield curve, all we mean is let's take a set of bonds issued by the same entity, typically the US government, and let's plot the yields to maturity of bonds with lots of different maturities. Short bonds that mature in, say, 30 days or 3 months or a year, and long bonds that mature in, say, 10 or 20 years. When we do that, we typically find that long maturity bonds have higher yields than short maturity bonds. But that's not always the case. So what can we learn about the economy from the shape of the yield curve? That's what we want to talk about today. All right, so the yield curve is going to be a way for us to learn about expected inflation based on interest rates. To see how that works, let's remember what determines bond yields. And of course, it's risk. But specifically, we're talking about a bond yield decomposed into a risk-free rate plus some sort of risk premium. And those risk premiums broadly are made up of 4 types: an expected inflation premium, an interest rate risk premium, a liquidity premium, and a default premium. Now for the yield curve, we're going to be dealing with U.S. government bonds. U.S. government bonds are highly liquid and they're default risk-free, which means both of these things are zero, and so they're not relevant to the bonds we're talking about. So the bonds we're dealing with really are made up of a risk-free rate plus risk premiums for expected inflation and interest rate risk. So when we calculate a term spread, which is just the slope of the yield curve, a term spread is the yield to maturity on a long-dated bond less the yield to maturity on a short-dated bond. These bonds need to have the same issuer. Again, that will usually be the U.S. government, but could be any issuer. And most commonly for a term spread, we'll take a 10-year bond minus a 2-year bond, or sometimes a 10-year bond minus a 3-month bond. All right, well, what happens when we do that? Suppose we're taking a treasury and we've got this yield to maturity from a 10-year bond minus the yield to maturity on a 2-year bond. Well, if we write that out, it's a risk-free rate plus an expected inflation over 10 years plus an interest rate risk over 10 years minus the risk-free rate, the expected inflation over 2 years, the interest rate risk over 2 years. So when we go ahead and solve that out, the risk-free rates, of course, will cancel, and we're left with the change, or the difference. I'll use the delta symbol there. The difference in expected inflation over from 2 years to 10 years, plus the difference in interest rate risk, again over the 10 and 2-year periods. Now, usually we would think that, look, the risk of inflation over 10 years is higher than the risk over 2 years, so this thing would be positive. And when are interest rates risky for us as a bond investor? They're risky when they go up a lot, right? If interest rates go up, then bond prices go down, and if I have to sell before maturity, I'm going to take a capital loss. And so I'm worried about interest rates going up a lot. That's probably more risk that happens over 10 years than over 2 years, simply because there's more time for it to occur. So that's probably generally positive as well. And so we generally would expect this term spread to be positive. That's equivalent to saying we expect the yield curve to slope upward. Well, that's generally what we see. So here's the yield curve as of January 26th. It's in the pink. I'm graphing here the yields on government treasury bills, 1 month, 3 month, 6 month, as well as treasury bonds, 2, 5, 10, and 30 years. The pink line shows the quote as of today, and the blue line shows it as of a year ago. And in both cases, you'll see, look, the yield curve is upward sloping. Investors are demanding a higher premium for the long-term bonds than for the short-term bonds. That's generally true, but it's not always true. Okay, so let's do this in practice and we'll see. In practice, we'll start with the 10-year treasury bond yield from Fred. That's Fed code DGS10. And we'll subtract out the 2-year, or sometimes 3-month. But for now, let's do 2-year Treasury bond yield. That's Fed code DGS2. Okay, so to do that, let's go ahead and jump over to Fred. Search for DGS10. You'll pull up the constant maturity 10-year Treasury yield. We want to subtract from this the 2-year yield, so let's edit our graph. Under Customize Data, search for DGS2. Go ahead and add this to our chart, and you'll see now we have an A, which is our 10-year Treasury yield, and a B, which is our 2-year Treasury yield. The term spread then is just A minus B, or 10-year minus 2-year. We'll go ahead and apply that. All right, let's look at this a little bit more closely. So you can see, again, this spread looks to be generally positive, but it's moving all over the place. Sometimes it's very small, and sometimes it widens and gets quite big. Let's take a little bit bigger picture view. So as we look over the last few decades, we'll notice something. The term spread occasionally turns negative. What does that mean? That means the yield curve is sloping downward. We call that an inverted yield curve. Well, what pattern do you notice about when the yield curve is inverted? Well, look here. We've got negative term spreads and then a recession in the 80s. Negative term spreads, another recession in the early 80s. Negative term spreads, recession in the early 90s. Negative term spreads, recession in 2001. Negative term spreads, financial crisis. Negative but just barely term spread, COVID crisis. The pattern that emerges seems to be that negative term spreads or inverted yield curves tell us something about the economy about to turn negative. Now, why would that be? Well, let's try and figure it out. A negative term spread means that the sum of these two things is negative. Let's just focus here on interest rate risk for a moment. If the interest rate risk difference between 10 years and 2 years is negative, that means there's more interest rate risk over the 2-year period than over the 10-year period. Again, what's the risk to a bond investor? The risk is that interest rates go up, driving bond prices down. What does that mean? If this thing's negative, that's going to imply what? Interest rates in the future are lower. Right? The risk today is higher than the risk in the future to make this thing negative. That means interest rates are higher today than I expect them to be in the future, or higher over the next 2 years than I expect them to be over the next 10 years. All right? Well, when do interest rates get lower in the future? When does a central bank drive interest rates low? It's when the economy's in bad shape, right? When we're trying to stimulate the economy, when we're in a recession, is when the central bank drives interest rates to be really low. And so, expectation that future interest rates are going to fall suggests an expectation that the future economy is going to be not very good. All right. Well, what about the other part, this expected inflation? If this thing's negative, what does that mean? That means I expect prices to do what? So it means that I expect prices to go down. The risk of inflation over 2 years is higher than the risk of inflation over 10 years. Or said differently, over the longer term period, I expect inflation to go down. Well, when does inflation go down? When do prices fall? Not in good times, right? In good times, we see prices increasing as business activity increases. When do prices fall? They fall when no one's buying anything. When does that happen? Only in recessions. So the punchline, a negative term spread or an inverted yield curve suggests that markets are anticipating declining inflation or an impending recession. Empirically in the data, that seems to have worked okay. It's not a perfect indicator, but it's a useful signal that the market is worried about the future state of the economy. All right, so taken together, we can think of both the credit spread and the yield curve as telling us something about the recessions. The credit spread tells us in real time how bad is the recession, how bad is the state of the economy. It doesn't do a very good job at predicting ahead of time, but when we're in the midst, it can tell us how bad things are. The yield curve, in contrast, is a little bit like a crystal ball. It can give us an insight into what the future state of the economy might be like. However, just like a real crystal ball, the yield curve is far from perfect at predicting the future economy. We should take it with a big grain of salt.